advice to investors has always been to buy stocks for the long term. What's long? When you purchase a stock, you should think of yourself as a partner in the business forever or until you need the cash. But forever or even 30 years is way out on the dim horizon. A more manageable view might be 15 years. If you invest $10,000 today in a stock that returns an average of 12% per year, a return that is 2 percentage points higher than the historic long-term return of the Standard & Poor's 500 stock index, you'll end up with about $55,000. Here's a look at 10 company stocks to buy ahead of 2035. Let's get into the video. Number 1. Apple. Speaking of cash cows, I believe Apple remains safely in the top 10 even if its growth rate were to taper a bit. Keep in mind that Apple generated nearly $100 billion in operating cash flow over the trailing 12 months, which means the company has an abundant cash pile to buy back its stock, pay dividends, reinvest in innovation, and make the occasional acquisition to bolster its product portfolio. In the years to come, Tim Cook will continue to oversee Apple's transition to a services company. Subscription services boast higher margins than most products Apple sells and will help reduce the revenue lumpiness associated with tech replacement cycles. Number 2. Amazon. Amazon is the undisputed leader when it comes to online sales in the United States. A report from eMarketer issued in March 2020 forecasts that Amazon's share of U.S. e-commerce would grow 100 basis points in 2021 to 39.7%. This essentially means that 40 cents of every $1 being spent online is routing through Amazon. But as you may know, retail margins aren't the best. Amazon overcomes these two ways. First, it's signed up more than 200 million people worldwide to a Prime membership. The fees it collects from Prime pad its pocketbook and allow it to undercut the competition on price. What's more, Prime members have added incentive to stay loyal to Amazon's ecosystem of products and services. Second, Amazon has ancillary operations beyond retail. In particular, its cloud infrastructure segment, Amazon Web Services, or AWS, has become an industry leader. Annual run rate revenue for AWS is already $54 billion, and this segment is significantly more profitable than retail. At the rate Amazon's operating cash flow is growing because of AWS, I wouldn't be surprised if Amazon surpassed Apple well before 2035 rolled around. Number 3. Tesla. A lot would have to go right, but it's possible that electric vehicle or EV manufacturer Tesla Motors could surpass Apple and become the largest publicly traded company over the next 14 years. To be upfront, 14 years is a lot of time for a company to mature and potentially build on its first-mover advantages in the EV space. Tesla is the first auto company in more than 5 decades to successfully build itself from the ground up to mass production. After delivering just shy of 500,000 vehicles in 2020, Tesla has reiterated its outlook for average annual delivery growth of 50%. This puts the company on track to hit more than 1 million EV deliveries in 2022 and perhaps north of 2 million by 2024. The company has 2 gigafactories already in operation in Fremont, California and Shanghai, China, and expects to bring 2 additional gigafactories online in the not-so-distant future in Berlin, Germany and Texas. Tesla also has clear-cut battery advantages. During the company's Battery Day event in 2020, it noted that its battery possesses better range, more capacity, and superior power to its competition. As one additional reminder, don't overlook Tesla's role as an energy company either. Energy storage may be playing a distant second fiddle to EV production, but it has a chance to be for Tesla what AWS has become for Amazon. However, the cards will need to fall just right for Tesla to surpass Apple. The biggest challenge will be maintaining its competitive edge and market share in the US and China, especially with most major auto stocks spending tens of billions on EV and autonomous vehicle research and production. For Tesla to be number 1, it's going to have to mature as a company very rapidly. Number 4. Air BNB. There's a very good chance that at least a handful of the top 10 biggest companies by market cap in 2035 are way down the market cap list in 2021. If I had to choose a true long-shot candidate to surpass Apple by 2035, it'd be stay and hosting platform Air BNB. Its current market cap is only $93 billion, meaning it has more than $2 trillion in ground to make up for Apple over the next 14 years. The answer to why Air BNB is simple. It's revolutionizing the hotel and travel industry. It's taking a traditionally stodgy industry and allowing transparency and personalization to do the talking. What's absolutely crazy to think about is Airbnb has achieved a $93 billion valuation with only 4 million hosts worldwide. In the US alone, there are north of 130 million households, and probably well over 1 billion globally. Airbnb has managed to penetrate just 4 million households as hosts so far. The company is just scratching the surface on the hosting side of the equation. Furthermore, Airbnb isn't happy just being a hosting platform. The introduction of experiences, for example, activities hosted by local experts, years ago signaled its intent to be the world's go-to travel source. During the pandemic, Airbnb brought virtual experiences to its customers, demonstrating the lengths to which it can adapt to any economic environment. But maybe the most impressive thing of all is how Airbnb is attracting users to its platform. My colleague John Quast noticed that a mere 9% of users booked a stay during the first 9 months of 2020 because of an ad. That means 91% of users booked with Airbnb because they were familiar with the brand and services, or they were suggested by someone they knew. Airbnb has brand staying power that could eventually rival Apple. It's a long shot to become the world's largest public company by 2035, but it has an entire world of potential customers with which to build its foundation. Number 5. Visa. As of May 25th, payment processing giant Visa had a $487 billion market cap, $3 billion ahead of JP Morgan Chase. I believe in 14 years it'll still be clinging to a top 10 spot and likely pushing above a $1 trillion valuation. Visa is a cyclical business, which is a simple way of saying that it does really well when the US and global economy are expanding and it struggles a bit when recession arises. However, this is a numbers game Visa is well prepared to play. Periods of expansion last significantly longer than contractions. What's more, Visa isn't a lender, which means it's not required to set aside cash for delinquent loans when recession strikes. Thus, why it bounces back so quickly from economic contractions. With the majority of the world's transactions still conducted in cash, Visa's growth runway extends decades into the future. Number 6. Square. Fintech stock Square has a very real opportunities to surpass PayPal over the next 14 years and work its way into the top 10. Although Square should see steady growth from its seller ecosystem, the company's primary driver will be peer-to-peer digital payments platform Cash App. In 3 years, Cash App's monthly active user count has more than quintupled to 36 million. It's been a more popular download than PayPal's Venmo, and Square has been generating $41 in gross profit per user, compared to less than $5 in acquisition costs per user. Square also completed the charter process to operate its own bank in March. This gives the company a full gamut of financial services it can offer in the high-margin digital banking space. Number 7. Alphabet. As with Facebook, ad-driven operating models come with risks. Thankfully, Alphabet has ancillary operations and history on its side. In terms of ancillary businesses, streaming content provider YouTube has grown into a top 3 social media destination, and cloud infrastructure service Google Cloud now has an annual run rate of more than $16 billion. Eventually, cloud is going to do for Alphabet what AWS has done and will continue to do for Amazon. Meanwhile, Alphabet's core business, its Google Internet search engine, should benefit from long periods of economic expansion. And the company's insane global share of internet search, which has ranged from 91% to 93% for 2 years. Lard your portfolio with stocks like these, but also diversify with a few index funds. As usual, I make no guarantees. Use these choices as a starting point for your own research, and happy long-term hunting. Leave a like and subscribe if you enjoyed this video, and tell us your top picks for stocks in the comments.